Welcome back to The Explainer. You know, we're all about taking these giant, complex topics and breaking them down into really clear, visual stories so you can actually use that knowledge. And today we're looking at a massive system, one that dictates the flow of global wealth, creates lifelong careers, and, literally has entire television networks dedicated just to trying to figure it out. We are talking, of course, about the stock market. But hey, rather than starting with those flashing red and green numbers and Wall Street tickers, we're going to start our journey somewhere completely unexpected. If we really want to demystify how these financial mechanics actually work, we've got to go back in time.
Okay, let's dive into this. How exactly did a 17th century spice voyage accidentally invent global finance? It kind of sounds like the plot of a crazy historical adventure novel, doesn't it? But actually, the true origins of the modern stock market are totally rooted right here in the epic tale of the Dutch East India Company.
Section 1. The First Stock Market.
So, back in the 1600s, global trade was definitely not a matter of just clicking a button online. Just think about these goods for a second. Gold, fine porcelain, exotic spices, gorgeous silks. The Dutch East India Company was actually sending out hundreds of wooden ships to sail across the globe to trade these highly coveted items. But launching these incredibly grand expeditions, well, it created a massive financial problem. It was ridiculously expensive. Way beyond the means of almost any single entity out there. So, to fund these massively expensive voyages, the company got creative. They actually turned to everyday private citizens. They allowed individuals to invest their own personal money to help support a trip. And in exchange, well, those investors would get a cut, a share, of the ship's profits when it finally returned home. People actually started selling and trading these shares in local coffee houses and shipping ports all across the continent. This whole practice let the company afford even grander voyages and, it increased profits for savvy investors too. Without even realizing it, by doing this, the Dutch East India Company had unknowingly invented the world's very first stock market.
Section 2. Launching a public company.
All right, let's fast forward to the modern era. Today's market is, well, let's just say it's significantly more complicated. So let's use a really relatable hypothetical. Just imagine a brand new coffee company, and they are looking to expand. Here is exactly how they get there. First, they advertise themselves to the big investors. If those big players buy the pitch, step 2, they sponsor the company's initial public offering. And finally, step 3, that major sponsorship basically acts as the rocket fuel to launch the company right onto the official public market.
So the crucial point is understanding this IPO, or initial public offering. If we're talking mechanics, this is literally the exact moment the gates swing open. It's the official public launch where anyone, and I mean anyone, who believes the business can turn a profit can step right up and buy in.
And what are they buying? A stock. By purchasing a stock, an investor is essentially buying partial ownership. Going back to our coffee company scenario, your investment provides the literal, actual capital they need to grow the business. And as they get more and more successful, the perceived value of the company rises, which of course attracts more buyers who are super eager to claim their own little piece of the pie. Section 3. The supply and demand seesaw. Now, once a company goes public, its stock price definitely doesn't just sit still. It enters this really delicate balancing act. You can think of it like a giant seesaw. On one side, when demand increases, prices rise. This is great because it rewards existing owners and helps fund shiny new corporate initiatives. But on the flip side, if profitability even just seems to dip, demand drops. Investors start selling off to avoid taking a hit, and that drives the price, along with the company's overall market value, straight down with it. Section 4. What drives the market? So if we zoom out from our little micro coffee company to the macro, big picture level, what is actually tipping this seesaw every single day? Well, companies are caught in this massive web of market forces. We're talking about the fluctuating prices of raw materials, crazy rapid changes in production technology, or shifting costs of labor. Combine all of that with sudden leadership shakeups, some bad PR, or maybe a brand new set of trade laws. All these overlapping, constantly moving variables generate the day-to-day noise and volatility you see in the market. But, beyond all the math and the spreadsheets, there is a totally fascinating psychological element at play here too. Look at this quote. Human confidence in the market has the power to trigger everything from economic booms to financial crises. It is so incredibly true. In the market, perception is quite often reality. Simply appearing to lose value can easily trigger a massive panic sell-off, which honestly makes human psychology one of the absolute most powerful, yet incredibly difficult to track, drivers of the entire system.
Because this wild human element makes the market such a highly unpredictable system. We usually see a major split in how people handle it. On one side, you have folks trying to make quick cash, basically gambling on that daily noise. And on the other side, reliable long-term investing. Now, financial experts are constantly building these complex tools in an effort to increase their chances of success. But because of that pesky, unpredictable human variable we just talked about, most professionals strongly promote reliable long-term investing strategies over trying to make a quick buck.
Section 5. Investing for everyday people. And this brilliantly illustrates the best part of all of this. The stock market is no longer this exclusive, gated community reserved only for the ultra-wealthy or those massive entities sponsoring IPOs. Not anymore. In today's internet age, everyday investors have the exact same access. Armed with just a little bit of education and a smartphone, literally anyone can buy stocks, back the businesses they truly believe in, and take real control of their own financial future.
So, we've traveled all the way from those perilous wooden 17th century spice ships to the instant digital trades of today. The mechanics have certainly evolved into a pretty complex system of supply, demand, and wild market forces. But that core engine, it remains exactly the same: human belief in the future of a business. So the very next time you're standing in line buying a cup of coffee, ask yourself, are you just going to be a customer, or are you ready to be an owner? Thank you so much for joining us on this explainer, and as always, keep learning.